Oil has snapped lower. AI-related debt keeps climbing, and central banks line up this week. 4 cross-asset allocators. The next few days could reset how equities, bonds, and credit share risk. Welcome to vTalkInsight, Allocators Lens Daily for July 28, 2026. Let's start with equities, where strong earnings and a powerful AI capex boom meet rising questions about valuation and concentration. In equities, strong fundamentals are colliding with growing fragility. Index levels are close to recent highs, and the volatility index sits in the high teens, signaling only moderate concern. This is happening just as the calendar compresses a heavy earnings slate with major central bank decisions over the next few days, leaving little margin for disappointment. Earnings momentum is a clear support. Current quarter profit growth for the S&P 500 is running near 70%, an unusually strong rate more typical of post-recession recoveries than late-cycle phases. Roughly a third of the index by market value reports this week, including several mega-cap technology names, while European earnings growth around 12% is beating expectations, helped by pharmaceuticals and semiconductor equipment makers. AI remains at the heart of equity leadership. Demand for advanced chips is expected to outpace supply for another year or more, supporting earnings growth and capital expenditure across the semiconductor complex. Data center and grid companies linked to electrification are seeing revenues grow above 25% with expectations for even faster earnings. Yet their valuations are not as stretched as the broader equity market. Global capital expenditure is accelerating, with data centers, semiconductors, and utilities now accounting for about 40% of world capex, up from roughly 20% in 2022. That shift is feeding a powerful industrial upswing, especially in European capital goods and fast-growing Chinese chipmakers. High-profile initial public offerings and strategic partnerships in memory and AI infrastructure show that investor appetite for the theme remains intense, even as day-to-day price action in chips turns more volatile. Under the surface, however, fragilities are building. Market gains are heavily concentrated in AI-related assets, and commentary warns that if these trades stumble, the lack of diversification could turn a routine setback into a sharper correction. Strong results from megacap tech are no longer guaranteed to lift share prices. Earnings misses are punished more than beats are rewarded, and investors are rotating toward financials, travel, leisure, and other beneficiaries of lower energy costs. At the same time, valuations for broad equities look rich versus history, especially given that bond markets are pricing higher for longer policy rates. Excessive AI capex funded with rising debt is being questioned, with some deals raising concerns about circular financing between chip suppliers and the data center projects that buy their hardware. For allocators, the central equity questions this week are whether stellar reported numbers can clear a very high bar, and how sensitive pricing proves to any hawkish signals from the Fed or Bank of Japan, especially now that oil and geopolitical risks have eased for the moment. In rates, the dominant theme remains higher for longer yields colliding with a heavy supply calendar. Bond markets are pricing in persistent inflation and a belief that the Fed and its peers will keep policy restrictive, pushing long-end yields higher and weakening bonds as a portfolio hedge. Current 10-year yields in the 4 to 5% range are increasingly seen as a return to pre-crisis normality rather than an aberration, which changes how duration risk is viewed in multi-asset portfolios. The Federal Reserve meeting sits at the center of this week. Market pricing implies a meaningful chance of another hike by early autumn, yet many observers expect the Fed to stay on hold for now, especially after softer inflation data and the recent drop in oil prices. That pause would come against the backdrop of rapid credit and money growth and projections that inflation will remain above 2% through 2028, raising the risk that delaying action now could require higher rates later if new supply shocks hit. Complicating matters, the Fed is moving away from strong forward guidance, which means any unexpected move risks triggering outsized volatility as markets rush to infer the reaction function. Heavy Treasury issuance in the front and intermediate part of the curve is also exerting upward pressure on yields that is more about supply than growth. Persistent fiscal deficits and concerns about long-term credibility help explain why curve dynamics look abnormal and why bond prices are increasingly sensitive to auction outcomes and policy surprises. Globally, policy divergence is intensifying. The Bank of England faces slowing growth and falling gilt yields as markets anticipate a more cautious stance, while the European Central Bank still talks about further tightening even as lower oil prices pull core yields down. The Bank of Japan is signaling a willingness to adjust policy more quickly than investors had expected, which could send ripples through global term premia. For allocators, the key rates questions are how far long end yields can rise before they destabilize rich equity valuations, and whether this week brings more clarity or simply another turn higher in volatility. In credit, the AI capex boom is increasingly a story about balance sheets. Hyperscalers have raised roughly $225 billion of debt this year, and AI-related corporate issuance is approaching $490 billion, much of it at the long end of the curve. This funding is supporting massive data center and infrastructure projects, including proposals measured in the hundreds of billions of dollars, and is turning some tech balance sheets into something that looks more like regulated utilities. The rising cost of capital is the flip side of that story. Companies with negative free cash flow, including parts of the hyperscaler and chip ecosystem, are more exposed as yields back up and investors demand higher coupons to absorb heavy supply from both governments and corporates. Concerns are emerging about credit quality and even circular financing, where chip makers help fund projects that will then purchase their own hardware. History suggests periods of exuberant capex financed by leverage can lead to lower long-term equity returns and more volatile credit spreads. So far, credit markets remain orderly, but there are early signs of differentiation. European spreads have been more resilient than in the United States, partly because AI-related issuance is lower, while private credit and leverage borrowers tied to software are seeing more scrutiny. At the same time, many portfolio managers are relying more on options and derivatives for downside protection rather than assuming bonds will diversify equity drawdowns. For allocators, the credit focus now is on how much more AI and fiscal issuance markets can absorb before spreads need to reprice more meaningfully. In foreign exchange, recent moves in major currencies have been tightly linked to energy-driven terms of trade shifts. Europe has been under pressure from persistently high gas prices, but the latest sharp declines in Brent and European gas are offering the euro some relief and supporting German and broader European equities. That makes the single currency highly sensitive to every twist in oil and gas, as cheaper energy simultaneously eases inflation concerns and improves growth prospects. Policy divergence is the other key driver, a Fed that is likely to hold rates near current levels while signaling higher for longer keeps the dollar supported, even if an outright hike is not delivered this week. By contrast, the European Central Bank still leans hawkish despite soft growth. The Bank of England is edging toward caution as gilt yields fall, and the Bank of Japan is hinting at a faster shift away from ultra-loose policy, which could lend the yen more support over time. Risk sentiment also matters for currencies. A decisive de-escalation in the Middle East and a rotation away from crowded U.S. tech and AI trades toward non-U.S. markets could take some shine off the dollar and boost currencies tied to energy imports or emerging market growth. At the same time, episodes like Indonesia's recent market wobble after an unexpected central bank resignation are a reminder that idiosyncratic policy shocks can quickly feed into local FX, equities, and bonds. For allocators, the FX watch list centers on how this week's central bank decisions and oil moves reshape the balance between dollar strength and opportunities abroad. In commodities, oil remains the main shock absorber for geopolitics and growth. Brent crude has fallen sharply from recent peaks above $100 to below $90, with some estimates suggesting a drop of more than $13 in just a few days as U.S. and Iranian strikes pause. European gas prices have also pulled back, giving energy-intensive economies like Germany some breathing room and fueling rallies in sectors such as travel, leisure, and retail. Yet the underlying risk premium has not disappeared. Shipping through the Strait of Hormuz remains constrained. The Red Sea and Suez routes are experiencing delays, and commodity exports out of the region are still below pre-conflict levels. The current ceasefire has an August deadline, and negotiations on nuclear policy and sanctions are stalled, which means a renewal of hostilities could quickly send crude back higher. Many portfolio managers still see an $85 to $90 trading band as a reasonable base case, even if tensions stay contained. Energy price volatility is acting like a tax on growth, particularly in Europe, where swings in oil and gas and in interest rates are dragging on activity. At the same time, climate events, from heat domes boosting power demand in the United States to severe wildfires in France and Spain, are adding another layer of uncertainty for utilities, agriculture, and insurers. For allocators, commodities remain the channel through which both geopolitical risk and climate stress feed into inflation expectations, central bank behavior, and ultimately cross-asset volatility. Pulling it together, equities are riding a wave of strong earnings and an AI-driven capex boom. But rich valuations, concentrated leadership, and a crowded event calendar leave them vulnerable to any disappointment on policy or profits. Rates markets are still adjusting to a higher-for-longer world shaped by persistent inflation, heavy sovereign issuance, and less predictable central banks, while credit has become the funding engine for AI and fiscal ambitions, raising questions about how much leverage the system can comfortably absorb. In foreign exchange, energy terms of trade and policy divergence sit in the driver's seat, and in commodities, oil and gas continue to translate Middle East geopolitics and climate shocks into macro outcomes. For cross-asset allocators, the near-term focus is on this week's central bank meetings, the cluster of mega-cap tech earnings, and whether the recent fall in energy prices proves durable or just another pause in a volatile regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.